Most likely, you already know that entities often pledge their property, plant, and equipment as collateral to secure long-term loans. It is not surprising, therefore, that analysts compare a firm's plant assets net of their accumulated depreciation to long-term liabilities in order to evaluate its ability to obtain long-term financing on the strength of its asset base. The name and formula of this ratio obviously tell us how many times non-current liabilities can be paid out of the net plant assets. It suggests how well a firm manages its long-term debt. Hence, this is a solvency ratio. The entity which is the subject of our study has these four types of plant assets with total net amount of 15,430,000. It is necessary for me to point out that I box these property, plant, and equipment accounts, not this description of total non-current assets, to make it very clear that the asset classification property, plant, and equipment is not the same as non-current assets. Property, plant, and equipment is just one group of non-current assets. There are other non-current assets which are not property, plant, and equipment, such as long-term investments and intangible assets. Please be well aware of that, because I've seen articles from the internet confusing property, plant, and equipment with non-current assets. As you can see here, however, Elizabeth Tailoring Materials Store does not have other non-current assets aside from these fixed assets or property, plant, and equipment or plant assets. Therefore, this total non-current assets of 15,430,000 is also the total net amount of the plant assets. How about the company's total non-current liabilities? 1,200,000. Its plant assets to long-term liabilities, therefore, is 12.86 times, which is a good enough ratio. Just like other ratios, however, to be more meaningful, this ratio must be compared with that of previous periods and other entities.